I love talking about topics in foreign exchange because I started off my career in investment banking in FX markets. Hello, everybody, and welcome to this YouTube video on what is currency carry trade that is largely taken up by hedge funds in the foreign exchange markets in order to not only hedge their underlying portfolios but also initiate arbitrage trades in the FX markets. I'm your learning partner, Sushila Hariharan, and if you're interested in a career in fund accounting, corporate action, trade life cycle, and OTC derivatives, remember to watch my videos where I provide content centric, research focused material on these topics. Let's take a look at foreign exchange markets. As you know, they are global in nature, they are cross border, they are cross currencies, they operate almost 24 hours a day. And because of capital account convertibility in almost all currencies, especially the major currencies like USD, EUR, JPY, etc., we find that hedge funds actively and aggressively trade in foreign exchange markets. I've already uploaded a few videos on FX markets because, frankly, they're such an exciting market to work in. And really, FX is one of the most global markets, giving tremendous opportunities to make millions of dollars in large trading positions. Let's take a look at some of what are the trades that FX traders do in hedge funds. And if you're working in a hedge fund, you will understand that foreign exchange is normally traded in currency pairs. What do we mean by currency pairs? I've already uploaded a video on currency pairs, understanding how the trades and currencies are quoted, because it's very unique in the world how currencies are quoted. The currencies are quoted in pairs, okay, like a couple, as simple as that, okay, jodi, one against the other. So if the quotation looks something like this, USD slash EUR, it typically means that USD is the base currency. What do we mean by base currency? Any currency that is quoted against this base will be per $1. Okay, so over here the base currency is USD and the quote currency is EUR. The quote currency is also called as the reference currency, or the currency that is changing. So in India we have USD INR. So the INR is quoted against the dollar. So $1 more or less remains the same, but it's the rupee that appreciates or depreciates against the dollar. So that in our mind, when the currency is depreciating or appreciating, it means that the base currency is appreciating or depreciating. Okay, so that makes tremendous sense to understand the logic of how currencies are traded. The most exciting currency pair in the last 2 decades has been the USDJPY. Well, of course, the euro was introduced way back in 1999 and has made some bit of an impact in the markets. The USDJPY currency pair is extremely fascinating for an FX trader. From his point of view or from her point of view, we're going to understand what is the meaning of this trade between USDJPY. Look, we're talking about two extremely strong countries in terms of GDP, in terms of growth, in terms of understanding why currencies move. Over here, as I have mentioned, USD is the base currency, JPY is the quote currency. Okay, now let's take a look at, and JPY stands for yen. The symbol for yen is Y with two horizontal lines. Let's take a look at some of the content in this video. Okay, now I've mapped out the graph for the USDJPY, which I have sourced from one of the popular websites on currency movements. And on 1st of December 2023, which is just a couple of days ago, the rate was 150. Okay, so that means the base currency is USD, so you have 150 Japanese yen, JPY, to $1. Okay, now if you look at it from the point of view of 1st February, okay, it was only 120. Okay, so from 1st February 2023 to 1st December 2023, the currency has moved from 120 yen to a dollar to 150 yen to a dollar. Now we're getting more yen per dollar. Or look at it this way: if we have to buy $1, we need to give more yen. right? So which currency has appreciated? Obviously, the USD has appreciated. And the currency for which we are getting more, or we have to pay more to buy one USD, that is JPY, has depreciated. Okay, now this has been the case for the last multiple, many years, and let's try and understand why this is happening. Is there an arbitrage opportunity for FX traders in this graph cycle? JPY is the currency of the country called Japan, and the yen on the Japanese, the interest rates on the JPY bonds are low. Okay, the Japanese yen interest rates are extremely low because the Bank of Japan has kept it low for almost 3 decades. Do you know how low is? Well, it's less than a percentage. Okay, and that's been the case since 1999, 1998, for almost 25 years, for almost 26 years, in fact. The Central Bank of Japan, called as the Bank of Japan, has kept the interest rates quite low. This is because the country was getting into was becoming economically very strong, very expensive, and their exports were fast superseding the imports, resulting into a strengthening yen. If the yen strengthens, then the dollar becomes weak. So therefore, they had to keep interest rates at low in order to kickstart economy and push currency competitiveness in the global markets. So what happened? The USD, on the other hand, the interest rates on the USD bonds are high. Okay, and this is because, as you know, in the last 2 years, ever since the lockdown has been relaxed, the Federal Reserve has kept increasing the interest rates, right? The T-bill rates have been increasing, the Fed rate has been increasing because US dollar is the currency which is facing super inflation in terms of the US economy. Inflation has been on an upward swing in the last 8 quarters. I'm recording this video in December 2023. So literally for 2 years, inflation has been a big cause of worry, and the Federal Reserve has increased interest rates almost 8 times in the last few times that they have met. Okay, so the Federal Reserve is concerned about inflation, so they kept increasing interest rates. So then this represented a great arbitrage opportunity for who? FX traders. So while Bank of Japan kept interest rates low in order to take care of Japanese economic interests, the Federal Reserve kept interest rates high in order to tackle US inflation. Who took advantage of all this? Yes, the ever attentive, the ever curious, the ever aggressive hedge funds operating in dollars and US JPY. So what do the FX traders do? They saw this opportunity. The USD 6-month interest rate is 5.5% per annum. The JPY 6-month interest rate is 0.07% per annum. Look at that. These are 6-month interest rates in two fully convertible currencies, two global currencies. Okay, and this is the difference between them. So what did the traders do? They took up something called as arbitrage. As we know, arbitrage trading is extremely profitable for those who can spot the arbitrage in the FX markets, and it represents the difference in the prices of assets, okay, in two different markets. So what do traders do? They buy the asset in the lower priced market and they sell it at the higher price market. Now, arbitrage is a very sophisticated term and is not easily detected. Okay, nowadays, of course, we have a lot of algorithmic trading, and algo trading demonstrates with their screener applications how we can actually do arbitrage trading, but that's a different story for another video. Over here, let's see how we can do an arbitrage trading as done by the hedge fund managers and the FX dealers. The trader therefore decided to borrow funds in JPY, converts the JPY into USD. Make sense? Obviously, the Japanese yen interest rate is so low, it's less than 0.5% for 6 months. So what do? They converted the JPY into USD. Now that the trader has all the USD, he has to deploy it in a market which will give him high interest rates. So he buys US denominated bonds. Dollar denominated bonds were paying 5.5% as we just saw, or they could lend in the dollar market. So now you've borrowed at less than 0.5%, and you're lending at almost 5.5% for the same duration of 6 months. This made things extremely attractive for the investors. They invested in USD bonds and they earned USD interest on those bonds. On the other hand, they borrowed in JPY, their expense was in JPY interest. As already discussed, they paid JPY interest rate of 0.75%. They earned USD interest of 5.5%. It made tremendous sense for them because then they realized that this is a great arbitrage opportunity. This is called as carry trade. Yen carry trade became so successful in the last 2 decades because traders were just buying yen, they were just borrowing in yen and investing in the dollar markets. As they kept investing in the dollar markets, the dollar became stronger and stronger against the yen. But the Bank of Japan refused to increase interest rates because it had to kickstart its economy out of recession. This meant that the interest that the traders were making a clear difference of hefty amount of profits on this trade. But is this trade risk-free? Because that's the main definition of arbitrage. Arbitrage means risk-free trading. This trade is unfortunately not risk-free because it's got something called as an FX risk. The foreign exchange risk is the risk of converting the JPY into USD, and once they dissolved or liquidated all the US denominated assets, they to convert those dollars back into JPY. So there is a very high element of FX risk which traders are completely aware of, and they would take a risk and understand how the trading would take place. If you like the content of my videos and want me to conduct some more topics, let me know by passing a comment on the YouTube links below. Thank you so much for listening in.